Okay, class, in this lesson, you are going to learn to compute federal and state income taxes using a table, tax table and tax schedule, as well as calculate the effective tax rate. So let's go ahead and begin. So just an overview of taxes. Hopefully you're aware that taxes come out of various sources, and it's used to pay for things like law enforcement, military, defense, national security at the federal level, as well as a bunch of other programs such as health research and social programs. Taxes are also taken out to support state and local governments as well. Now, the types of taxes that are taken out or are applied to us are property taxes. These are taxes that are collected based on the value of the property you own. Then there's also the sales tax, which most of us are aware now. So when you go out to the store and purchase something, they tack on a sales tax, which you pay on the purchase. And then income taxes, which is what we're going to focus on today in our examples. These are taxes or dollars that are taken out based on the amount of taxable income that you earn. Okay. Now, the part of the government, federal government, that collects your taxes is called the Internal Revenue Service, or the IRS. And then how you file your taxes depends on your what's called filing status. And this is a description of your marital. Let me go ahead and correct that. It should be marital, not Marshall. Your marital or family status as of the last day of the tax year, which has to be indicated on your tax return. Okay, so here are the four main filing statuses. The first one is if you're single. Obviously you're an unmarried taxpayer. The other status is also called married filing jointly, or a qualifying widow or widower. These are married people who fill out one tax return together, or if you're a widow or widower, you can file in this status if you meet certain qualifications outlined by the IRS. Okay, now the other two filing statuses are married filing separately. So these are people who are married, but they decide to file two separate returns. And then the last one is called head of household. This is a special filing status for certain individuals that are unmarried, but support people in addition to supporting themselves. Okay, and the requirements have to be met based on the IRS guidelines. Now, one thing that a lot of people misunderstand is that when we talk about taxes, everyone thinks, well, if you make a certain income level, then you're going to be taxed at a particular rate. That is somewhat true, but not exactly accurate. And that is because the income tax system in the United States uses what's called a progressive tax system, where the percentage of tax paid increases as income increases. Okay, so what this means is if you make, for example, $100,000 of taxable income in a given year, certain salary range, so let's say, and these aren't the exact numbers, but let's say if you make up to $30,000 of your $100,000 income, you're going to be taxed at a certain percentage. So let's say it's 7%, and then from $30,000 to $50,000, you're going to be taxed at 9%, and then anything above $50,000, you're going to be taxed at 15%. Okay, those are all fictitious numbers, but the point is you're going to be taxed at a different percentage at different dollar amounts. So as your income continues to increase, those brackets, if you will be taxed at a higher tax level. And so what accountants and tax professionals will do is they will calculate what's called the effective tax rate, and this is the actual percentage of tax that you're going to be paid. So in essence, the effective tax rate is represents the average rate applied, right? Because depending on the income brackets, you have different percentages. So the effective tax rate basically averages those out, and it tells you the true tax percentage that you are paying. Okay, so let's go ahead and take a look at example one. This is fairly straightforward. In this example, we're told that Ron is single, and after he completes his tax form, he finds out that his taxable income is $51,482. Okay, and here's the important thing. The key thing is taxable income. This doesn't necessarily represent gross income, but rather taxable income. And one of the things that brings down makes the gross income different from the taxable income is that sometimes there are deductions that causes your income level to come down. So whatever that number is, it'll bring your taxable income down to the lowest possible level, okay, legally. And so this is what you want to do, is to bring your gross income down as far as you can so that your taxable income is as low as possible. So in this example, the taxable income is $51,482, and we are trying to determine how much tax Ron owes. So if you take a look at this tax table, okay, you're going to look at the range where his income lands, and so that's right in here. 51,482 is greater than 450 but less than 51,500. And so you're going to scan across these columns, and the column that we would be interested in is this first one because this represents those that are filing single. And so the amount of tax that Ron owes would be $8,663. Okay, $8,663. Okay, let's take a look at the next example. So here we have a situation with a married couple, Maria and Don, and they're going to file their taxes jointly. Okay, we're told that their combined taxable income is $153,900, and so when your income goes above $100,000, the table's a little different, and now they're going to be giving you what's called a tax schedule. So this is where you're going to need to do a little bit of calculation to determine how much taxes Maria and Don owe. Okay, so if you take a look at the tax schedule, you'll see that there are ranges of income again, and so we want to find where $153,900 lands, and that's right in here. Okay, $153,900 is in this bucket, which means that the amount of tax that they're going to owe is a minimum of $29,387.50 plus 28% of any dollar amount above $151,200. Okay, so let's go ahead and calculate this. We're going to figure out what the difference is, how much they make over the $151,200, and then we'll go ahead and add in the $29,387.50 in taxes. Okay, so how this works is we're going to take $153,900 and we're going to subtract out $151,200. Okay, so that works out to $2,700. Okay, so then from $2,700, we're going to multiply that by 28%, or 0.28. Okay, multiply that out, and that works out to $756. Okay, so that's how much additional tax they have to pay because their income is above $151,200. Now we add in the $29,387.50, and that works out to $30,143.50. Okay, so this ends up becoming Don and Maria's tax liability at the federal level. Okay. All right, so let's go ahead and move on to example 3. Now we're going to calculate both the federal and state taxes. In this example, we're going to look at the California state taxes. And so we're told Miguel earns a taxable income of $250,000, and he did that in 2025. And we're going to calculate the taxes, the tax liability and his effective tax rate, okay? So here we have a table to determine federal taxes, okay? So we're gonna take a look at where this 250 lands in this bucket, and so it lands right in here. It's just below the 250, 525 threshold. So we're gonna go ahead and put in 250,000. And this tells us to multiply by 0.32, okay? So we're gonna go ahead and punch that in the calculator, and this works out to $80,000. Okay, but that's not the tax liability, because the next step, it says to subtract this 22,937. And when we do, we get a net of $57,063, okay? So that's the federal tax. Now we're gonna calculate the state tax for the state of California. Okay, similarly, we're gonna look at this chart and notice that this is for single. So we wanna make sure that whenever you look at a particular chart or table, that it is for the appropriate filing status, okay? So here, Miguel makes $250,000 taxable income, so that lands him right here. So his tax is going to be $3,201.97 plus 9.3% above the $72,724 level. Okay, so let's go ahead and calculate that. We're going to take 250,000 and we're going to subtract 72,724. Okay, and that works out to $177,276, okay? So that is the amount over the threshold of 72,724, and now we're told that it is taxed at 9.3%, okay? So we're gonna take 9.3% or multiply that by 0.093, and that gives us $16,486.67, okay? Now we're gonna add back, or add the $3,201.97, $3,201.97, and that gives us a total of $19,688.64. Okay, so that is Miguel's tax liability. So the federal tax, we calculated to be $57,063. And at the state level, we calculate that to be $19,688.64. So our total tax liability is going to be $76,751.64. Now, to determine the effective tax rate, we're going to take the $76,751.64. We're going to divide that by 250,000. And that works out to 30.7%. Okay, so that ends up becoming our effective tax rate. Okay, so this is the true percentage tax that Miguel is going to have to pay. Okay, so hopefully you have a better understanding of determining tax from a tax table as well as a tax schedule and calculating the effective tax rate. If any of this was confusing, please go back to the beginning of the recording and listen to it again. Thank you.